Hey, yeah, what? Grab your bootstraps, yeah, let's scale your growth. Here's the truth, Jack. We'll reach the globe, unveil the
Tanya,
notes.
what the
Pivot, earn your digits, won't burn, you'll get it. See, this is factual. Funds will show, learn to flow with Candid Capital.
This is a Candid Capital interview. In these episodes, we host industry business professionals involved in the global tech ecosystem to discuss various topics related to tech, global economy, and building sustainable businesses and investments.
Welcome back to the Candid Capital Podcast. I'm your host, Josh. Along with Web3 and the Metaverse, Fintech is another area of interest, specifically non-traditional banking services that can potentially enable digital nomads and the gig economy from anywhere. In this episode, the CEO and founder of SteadyPay, a UK-based fintech company, will discuss the gig economy and non-traditional financial services for gig economy workers with fintech. Welcome, John. Thanks for joining me today. How are you? How's your 2023 going?
Fantastic so far. I don't know where this was a cracker.
So usually how we get these things started is with the origin story. So how'd you get into tech? How'd you end up becoming an entrepreneur?
Yep, thank you. So I think for me, my tech journey started a long time ago, but not in a standard way. So for me, when I was at university, I did things like marketing and management, other technical to begin with. And it wasn't until I realized that actually I was probably a bit more of a nerd, and I should probably do more computer sciencey related subjects. And what I found was that both for some of the work that I was doing and some of the studies I was doing, that I tended to work well as a bridge between business and technology. So, if you go back 10, 15 years ago, business people were very business, technical people were very slide a pizza under a door, don't talk to me. So being able to act as that translation layer between the two of them was quite a valuable skill set, which is what fundamentally led me into doing a lot of technology consulting, which I did for Capgemini for a long time. And that's traveling around the world, doing a lot of solution design, technical builds, and custom implementations of software solutions for banks, utilities, those sorts of companies that tend to want to do those sorts of big things. And then after leaving consulting for other people, I basically started my own consulting business with a few other partners. So we built that from the ground up across Australia and New Zealand. So where's my funny accent from? New Zealand, not Australia. So for that consulting business, we built that up over several years. It predominantly focused on information management or business intelligence, data science, those sorts of things. As I like to jokingly say now, we used to do a lot of stochastic modeling, which nowadays they call AI. So I think I would have sold business for a lot more money if we'd called AI back then.
We have a colleague who that's like one of his triggers is to use like the AI buzzwords when he's just like, it's just statistical model.
Yeah, it's like the triggers. Well, the other trigger for me is it's like, I've got a brand new AI based startup. Cool. How much data have you got? None. So what are you using? How's your AI working again?
But I usually tell them, but it's statistical modeling with a soul.
Oh no! I guess it just wind them up even more in terms of how to trigger mathematicians or people in statistics. So the consulting business that went really well, and that was sort of my real, as a first taste of entrepreneurship. So I've done a lot of technology consulting in the previous role, and then actually here's build a business. Being able to, generate new sales, generate new customers, hire people, make payroll each month, all those sort of typical entrepreneur challenges is where I sort of, got that sort of grounding. Now, obviously, some of those things, dovetail over to just to sell when you're working with someone else consulting, yes. But when it's your business, it's all on you. And and fundamentally, you're at the forefront of pushing those things forward. And that's sort of the initial start, the more detail of the entrepreneurial journey. And then I think, why fintech for me is, having done a lot of work over the years for banks and sort of financial organizations, what we're fundamentally seeing, and we'll get to more steady pay in a minute, but what we're fundamentally seeing is we had done a lot of work there, had a lot of expertise to be able to make things better or create a lot of innovation in those areas. But what we were finding is, even when a financial organization had an innovation team, a budget, a desire, an executive mandate, it was still very slow, and it still tended to get bogged down in politics of people. So even if something was successful, that was almost the worst thing that could happen. So and we talk more into a couple of them, some of the internal banking things, like a fantastic app that produces brilliant insights for small business. Oh, it's much more successful than I thought it was going to be. Says some executive, how do I squash it? Because they had no idea how to actually make money out of it. So it becomes a cost line, and it just becomes a problem for them. So I think for me, the fintech was sort of it's that jewel where a large amount of my experience came from, and where I see we can make a massive amount of difference to how people interact with the world. So, example there would be, Web Summit last year, I spoke about fintech and solving the cost of living crisis, which you think, how do those two things go together? But that's the reality of actually being able to, with new technology, in this case, in a financial service sense, how do you help people navigate or drive through a financial crisis, or how do you help small business do better, and therefore drive the economy? If you think UK or most countries, 98% of companies are small businesses. If you're going to drive your way out of a recession, or pseudo recessions that all the countries that are at the moment, you're doing that through enabling small business.
So when you were selecting, I guess, the market and the tool to create and kind of target, was that, how would you say it was weighted between your experience versus maybe your data insights? As you mentioned, you were looking at a lot of analytical information.
I'd say sometimes, and you get sort of decision-making frameworks where some people are very gut-based. Some people have to show you the data. I'll tend to lean with the gut, but want to sort of trust but verify. So actually, here's what I think: can we quickly find data to justify and back up this particular thesis? So I think if you're looking at where what I was seeing at the time, which is 6-7 years ago, was you're seeing a massive groundswell in freelance work. You're seeing a lot of people wanting to go work for themselves. That sort of the start of the Great Resignation. People wanting more self-determination, control, flexibility, all those sorts of things. But that had obvious repercussions on their sort of financial lives that some people, especially if you're younger, weren't really thinking about what that meant. It's I'm never going to have a traditional job. What does that mean for me in terms of actually navigating the normal world and wanting to maybe eventually buy a house, or maybe even just buy a car. Is that still the same? Or I want to be a digital nomad and do a lot more travel and work from multiple locations, but
own nothing and be happy.
Exactly. Well, none of us want. I think more and more people are of the mindset that owning things does not make you happy. And experiences and connection and things are the way to go. But
well, I would say the WeWork person. I forget his name.
Human.
Yes. So there's like an article where he kind of makes a statement, and I'm like, the nice thing about not owning, let's say, a home is then you're not really responsible for fixing any of it. And his new innovation is that you will pay me rent, but you'll be responsible for fixing your own stuff. And so like he's like his grand idea is that people can plunge their own toilets. I think that's the quote.
Yeah.
And so
yeah.
it kind of just shifts people away from ownership, but not getting any of the upside from not having ownership.
Correct.
And if he's actually going to be this leader that makes this a trend, well, that's kind of terrible.
Well, yes. And I mean, this is where I would say that, and I bounced around with a lot of people on when he got his last round of investment from A16Z. Are A16Z now the Goldman Sachs of venture capital in terms of, they're not too worried about how they are morally perceived in the market by others and are therefore happy to invest in people. And I had long debates with multiple people on it, because you can take either end of it and say, oh, that's disgusting. How could they possibly invest money in someone who not only, because don't get me wrong, failure is not a big deal in the sense of like, a lot of startups fail, even especially in North America. If you failed once or twice, that's giving you this, the battle scars to be more successful next time. It's more the fact that you've failed spectacularly, still taken a lot of money for yourself off the table, but left a lot of people out of pocket that worked for you and all that sort of, so there's a lot of people, sort of the we crashed type of, all the, not necessarily the SoftBanks of the world, but all the ordinary people that were heavily impacted through it. Or you take very much the VC A16Z view of things and go, well, actually, I've got in this particular portfolio, I've got $1 billion to deploy. I cannot physically, in any real way, deploy checks of $2 million. It's not going to work. I don't have enough people, I don't have enough time, and the upside of those just makes no sense. So actually, I need to be deploying checks of 50 to 200 million in my deployment window of 18 months or whatever it is. Therefore, actually, Adam Newman, he's a good bet, and ignoring everything else.
Yeah, I probably have some less than popular opinions of that firm because I know they're the big star. But, I don't view them as a venture firm.
Well, interesting. Why not?
Because to me, they seem like they've evolved into something else. They resemble more like large Wall Street funds. And I suspect the only thing they have to do to get their LPs to keep giving them money is they just have to beat the market in returns. A pure VC firm is supposed to do a lot more than that. They're not aiming for like 6 to 12% range. Of returns. The other thing is because they've been able to consolidate all this capital, they're market makers. They can just decide this is how we want the market to go and this is how we want things to be. And because of their size, they're now able to attract everything. So really they're a monopoly that's not a venture firm anymore in the venture market. That's kind of how I view it. It's not just them. There's a couple others. So maybe an oligopoly. Maybe an oligopoly.
Yeah, because I guess you're seeing that more. Success is its own problem. If you've been super successful at raising lots of mega funds and you now have billions or tens of billions under management across multiple funds, across multiple sectors, you can sway the market, and you can also make it so that a lot of the deals that you're getting are the best possible deal. Both for you and the deals with the best people, because there is that, you say, A16Z and several others, marquee names that a lot of founders want on their cap table or think is some sort of badge of success. So I got A16Z as an investor. Is that good? Not really.
Well, I mean, I think the real problem with this is that venture starts moving away from enabling innovation and disruption. And so what you end up having is an analyst or a finance guy deciding what the market should be and what the world should look like, rather than the tech and disruption kind of an innovation making those decisions.
Which in like UK, Europe, there's always been a bit like that, in the sense that a lot of the people that work in venture, ex-banking, ex-PE, very few ex-operators. So they are really looking for that 4x return. So it's a bit more traditional and they're a bit more risk averse. I'd always considered, and I think maybe it's more history, and some of the firms are moving away from it. That for the US and North America in general, it's still a 10x plus return is what they should be looking for if you're still truly venture, and you should be not all, but a decent percentage of ex operators on your team.
I mean, the thing is, in reality, every monopoly or anything that's seeming to have the power of a monopoly is never good. And so, the argument that I would make is that because they're so large and they have so much of the capital centered on them, there's an incentive to make sure that no other technology that they have decided not to invest in, to not knight, does not get to disrupt some of their other investments that might not actually be innovative or disruptive. But if you had that same amount of capital distributed through emerging funds and not all finance people, or, a better mix, then that's where the competition comes. And that's where I think more innovation, because you're taking different bets. Yeah. And different people are taking different bets. Yeah, and so, that's really just kind of my view on it. I know it's not a popular view, but when you look at the funding of last year, the record amount of dry powder, it was, I forget how much, but it was just short of $1 trillion, I think.
Yeah.
But over 70% of it went into funds that are $500 million or more under management. So that to me already looks like, instead of we have Wall Street, maybe it's Silicon Valley. It's different.
Which is it's interesting because you look at the fund returns, and there's plenty of stats that show it, that if you're looking for the highest performing funds tend to be in the 250 to 500 million fund size, whereas above 500 they perform more like an index. So it's not that you won't get on average they don't return, but they don't return spectacularly more than you would if you just did an index.
Oh, I think as an LP, it's wonderful. I mean, if you're looking for somewhere to park some money, I think it's a great option for sure that you could go for. But I was just thinking about in terms of the industry, founders, tech disruption, that sort of thing.
And I guess that's where I'd agree. And I guess we've got a few founders across a couple of industries. I mean, I think crypto, which we might come to later, is one of the ones where there's the A16Zs sort of have a lot of power in what they're doing. And we do see, I see a lot of, and you can argue survival of the fittest and that type of thing, but you're going to see a lot of good founders struggling. They struggled last year; they're going to struggle again this year, because a lot of the, where that 70% of dry powder went, they have very specific criteria, which is very exclusionary for particular types of founders. Now, whether that's easy ones are, we only invest in exited founders that have sold their previous business for more than 50 million. Cuts out a large number of people, right? Now, if I was the VC or the LP, does that make sense? If you can get it, that makes sense, because why not? I've got enough market presence that I can demand that the only people that should cross my threshold and get my blessing meet this horrendous criteria. Are you going to potentially miss other stuff? Maybe, but you're also going to see a lot of founders squeezed out of markets or choosing not to do stuff because they're because of lack of access or lack of investment. Now you can take the very Darwinian view of they'll find a way. So, will they?
It's complicated, I suppose. I mean, but like I said, I think for competition wise, and I do think that eventually they're going to end up under some type of regulatory microscope.
Well, I think a lot of areas will, and I guess the other thing for me is that I know we're talking about fintech, but for a lot of the fintechs that I know, that especially the vintages that were sort of minted in, we'll call it, sort of 2020-ish, and then, or not 2019, 2020, and did quite a big round in sort of 20 and 21. They're coming to that very a realization that I think a lot of people, some of them, have struggled with, which is, what are you? I'm a fintech. Are you in financial services? No. Yes, you are. In terms of the sense of like the industry you're in as a fintech, and who you are competing with as other financial services firms. So, I think some people are still struggling to sort of get their head around the fact that actually we're in financial services, and I'm going to eventually, if I'm going to be successful as a business, be valued like a financial services business. So I'm providing financial services. How do I do it? And how do I do it with good unit economics?
So I think that kind of brings us to, what is SteadyPay?
So SteadyPay is a fintech with good unit economics now.
Oh, really? Tell me more.
Yeah. I'll tell you more, and then you can send us a term sheet. So SteadyPay is a fintech that I started here in London at the moment, so headquartered in London, but we'll be starting our global expansion this year. When we originally started SteadyPay, we touched on some of this already in terms of the mission was to make financial services more open and more inclusive. So, how do we turn a lot of those financial service no's into yeses for people and businesses? So what we wanted to do was create fundamentally a platform that we could make available either directly or white labeled that produced that outcome. So turn that no into a yes. So it sounds all sort of waffly at this point. Like, well, how does this work? What do you mean? So what we did was we went in with our initial view was we're seeing lots and lots of people and starting their own businesses, want to do freelancing, wanting to move into gig economy, and be on their own entrepreneur of one or a 3-person coffee shop or whatever it happened to be. How do we better enable those people? And the first problem we saw was, and we saw a lot of people that were in the sort of trend. There were a lot of startups doing pensions. There were a lot of startups doing doing insurance, even level insurance. But in the actual the finance space or the fintech space was very little innovation. Some people would rebadge a few things, but we weren't seeing a lot of innovation. So how do we create initially first up? How do we create parity between the salaried employee and the non-salaried worker who gets paid in a regular cycle? Contracting, freelancing, working at a retail shop, irrelevant. Whatever it is, how do we create that? So we created our income smoothing solution. It's still pretty much the only income smoothing solution you'll find, not only in the UK, but even in the US.
And so what is income smoothing?
So income smoothing, it basically means that we allow our users get a set amount each month, even when they earn an irregular amount. So the best way to think about it is, let's say normally you are used to earning 2,500 in a given month. For whatever reason, and we'll get to the reasons. I was sick. I took some time off. I had less shifts. I got the contract ended. Whatever. This month I only earned 2,000, so I'm 500 short of my normal earnings to allow me to easily pay my bills, live my life, etc. We advance the difference to bring them back up to that 2,500, and they slowly repay that over time. Subscription model, no interest, therefore the amount doesn't keep going up. So no risk of it blowing out like a credit card, which so a lot of people. Yeah.
So is the intention for it to work kind of like a micro business line of credit, or to supplement salary until they've processed the business income?
So both. So depending on how they use it, we can apply it as a business line of credit to stabilize the income of a business, or we can apply it to an individual to stabilize that individual's income. Now, that's where you get that sort of difference between here's a one person who's working for themselves, or a 3-person or a 10-person business, depending on what solution fits for that individual or their general circumstance. But the idea is, how do you solve that short-term angst, pain, stress associated with, I'm going to earn less this period and I'm not sure how I'm going to pay my bills, pay my staff, whatever. And especially if you're younger or early in your entrepreneurial journey, that's always a massive stress.
And so for the fees, so do the fees change based on, I guess, the economic activity? Like, how is that structured?
Having done a lot of risk-based pricing and stochastic modeling in my part in the past, very exciting stuff. What we actually looked at is we could do differential pricing, but actually people preferred a very simple, transparent, standard price. So what we ended up doing for the UK, for some of our partners, it depends on how the partner wants to distribute the product. So if it's an embedded solution, the pricing can look slightly different, because they'll roll it into their overall subscription offering, and provide it as part of their solution. For us, if we're making it available in say the UK as the income smoothing product, it's £7 per week for access of up to £1,000 for the purposes of topping up your income. Now, over time, the limit will increase, and on the business side, which to date we've done embedded, the limits are higher, but obviously it's a slightly different charging method as well.
Yeah, immediately I was thinking when I read that you don't do the interest, I was thinking this seems like Sharia banking. That was like the first thing that came to mind.
Yeah, so I mean, it was almost unintentionally Sharia compliant, which is quite handy for us. So we have had a decent amount of interest from the Middle East and other countries where this would be quite an innovative solution and a way for them to enable people without having the problem of actually this is actually lending, or has an interest rate.
Because I'm from a market that has interest. It's not something that really it's just part of life. That's just kind of how we are. But the thing that I really like, though, is that you don't have both, because banks in the West charge you fees and they charge you interest.
Exactly.
And it seems like double dipping to me.
Well, I think it is. So because it's almost that you're gonna pay at least once, even if you were doing nothing, you're gonna pay fees, and even worse, if you're doing things, we're gonna charge you fees and interest. So we're gonna if you're a high user, you actually end up paying more, which seems ridiculous. Like if you were using something a lot, shouldn't you pay less? But weirdly, as you say, a lot of them are double dipping, which I don't think is.
And at a certain point, insurance companies get their take as well.
Well, exactly.
Like if you really look at what it takes to get capital to do something, and you look at break it out into the different pieces.
And that's exactly it. So I mean, for us, there's a percentage of our base who think of the product as not, but think of the product like an insurance product. And the reason they like it more than insurance is because we pay out no matter what. Whereas, as you think, generally, I think everyone thinks this way now. An insurance company's job is to try and not pay you. Sorry, and you're not covered for this particular situation. What do you mean I'm not covered for this situation? Oh, we're only going to pay out 50%. Did you not read your policy? Oh, these 1,000 pages of really small print that you sent me. No, I didn't read it, surprisingly enough. So a lot of people, I think, have had bad experiences on the insurance side, and they've had bad experiences on the financial services side because they've had a bank or that has charged fees and interest, and they've potentially gone, I need a break for a month. Oh, you can have a break for a month, and we'll charge you more fees and more interest, as opposed to actually cutting them a break and creating a solution that actually works with them. So I guess that's what we've done in terms of the platform. With the income smoothing is the first product, and that's underpinned by, and this is where you get to sort of the area of if we had a secret sauce, is our AI-based open banking transit. So open banking.
Sorry, AI or statistical models? Have you named the AI?
Well, you have to put, look, in the modern startup world, it has to have AI on the pitch deck. You can't do anything else now.
But have you made it personable? Does it have a name? Did you name it John?
Wouldn't that be too much hubris?
Well, now you can't just be AI. It has to be AI enabled by Chat GPT.
That's true. And then you have to have a name. You have to call it some sort of name which is, I guess, is what we need to think of next. It's like, actually, the next release, it's going to have to have a name, and we're going to have to put a bit of Chat GPT behind it.
Talk to the marketing guy.
Yeah.
Go out, get you an avatar as well. So there's a nice visual.
We can't do worse than Zuckerberg's avatar when they first released his one. It looked like it was from 1990.
I did change my Facebook to an avatar, and my Instagram, it does have one. It's kind of weird, but the thing I like about it is the stickers and emojis that are customized to your avatar. That's the main thing. Those
are quite cool. So I think for us, so Steady Pay. Then what we realized from talking to our users is that they wanted a better access to traditional credit as well, whether they said it or not. So that, in their words, it was I want to be able to buy stuff. And what we realized is a lot of them were immigrants, a lot of them were new to the market. A lot of them were young, so they hadn't really built their traditional credit score. So, I mean, in the UK, it's a credit score. In the US, it's your FICO score. As you probably know from a US perspective, if you don't have a FICO score, you're not a real person. They're not far off it here.
If you can't consume, you're not a real person.
And therefore, to be able to consume, you must have a score. A consumption score. Maybe that's a new one. In terms of
they call it social credit. They call it social credit in China. We call it.
You're a good consumer. Sort of
Your credit score is slowly transitioning into your social score.
How good a consumer you are.
So, how many? What markets are you in currently?
So at the moment, direct to consumer, UK only. Is the market, and we're currently launching embedded in a couple of markets that we can't quite talk about yet because the customers won't let us.
Are there regulatory issues to do this in other countries, or is it pretty simple?
It depends on the country. So the highest level, so the FCA is the regulator here. They're still seen as sort of having a very high bar globally. So it generally means you can sort of turn up with your FCA documents or all the documents you supply to the FCA to a new country's regulator and get regulated relatively quickly if you need to be regulated. And that's why I say if. So depending on the country and depending on the service we're offering depends on whether we need to be regulated. So there's sort of some vagaries to each country, even within, say, something like the EU, where you go, we can surely just roll in. It's like, not quite. So some of the individual countries have slightly different rules.
And I mean, you might not be able to answer this question as you were not able to answer about the markets, but I was kind of just wondering in terms of maybe developed versus developing markets, lending or providing money, suggests a certain level of, I'd say, sophisticated trust in that market.
Yeah.
Because I noticed in at least some of the places I've been, even me as a foreigner with income and credit, and even if I were to get a permanent residency, it would be very hard to ever borrow money from a bank there. I could put as much money in the bank as I want, but borrowing in that country with that bank is a challenge. And even talking to locals, it's also a challenge for them, which is why fintech kind of exploded, because it's helped the unbanked. So where do you fit in this?
Absolutely. So I mean, I guess I come at it from the two perspectives. And I think there is a good opportunity as we move into sort of some of those heavily unbanked countries. But I'd also say that what we've seen is, I mean, I touched on it before with the immigrants, and the case study I like the most. Obviously, we've got a lot of customer case studies. But Ivan, who runs our partnerships, he moved to the UK from the Ukraine a year ago. Turns up in the UK, zero credit score. No one will loan him a single penny. Within sort of a few weeks, he finally registers enough addresses and things to get a score. His score is poor. So in terms of on a range of from poor to excellent, he's poor. He signs up to our credit building product. Within 6 months, his score is fair. Within 12 months, his score is good. So he's not quite an excellent yet, but he's actually tracked quite nicely across those scores over a 12-month period to now. Like as he was getting to fair, people would start to offer him credit. Now he's at good. He actually qualifies for quite a few of the what we'd consider to be the normal credit offerings for that particular market. So what we've found is in a lot of markets, creating a path to credit is as good as offering credit. So you can't just offer credit and then find out that, and we've got a few customers that had this scenario where they were offering credit, people were applying and getting declined. So there's thing for there's one of a small business neobank in the UK. They were doing a lot of partnering. So they were partnering for lending to the customers, and so people, their customers would go, oh yes, I want a loan. They'd apply and they get declined. So the conversion rate was less than 1%, and so very 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 low conversion. But it's because that they were quite new businesses. They didn't have a lot of trading history. That they may or may not have been immigrants. So that was sort of no surprise of them actually being declined. So having a lending product in that scenario wasn't very useful because actually the approval rate was so low. So then how do you create an on-ramp capability to be able to ramp people and using a fintech to get to that point of where they would actually be lending eligible? Now, ideally, potentially lending eligible for some of your things earlier, but eventually eligible for some of the mainstream products as well.
Yeah, I mean, I definitely think there's a market for it. I mean, the execution is probably the challenge. Micro lending, there's a lot when that started out.
There's a lot. I mean, I'd say lending, the biggest thing for lending, we've seen this across industries across time, as each sort of pocket of lending has happened over in phases. Is it's really easy to ship money out the door. So hey Josh, here, have some money. The real trick is getting it back.
Yeah, I think one of the more, I can't remember the name of it, but I mean, one of these micro lending in the early days and how they kind of figured it out is they stopped lending to men in some of these regions because they started seeing in the data that it's the women were more responsible with the money. And again, this is a very specific demographic.
Yeah.
But they were just wanting simple things to keep the house going, and so
exactly, and potentially more responsible in terms of managing the finances and actually paying, making those repayments. So
I just remember going to one of these seminars, and the guy's just like, well, we don't really lend to them because we know they're probably just going to go grab some beers.
Then that's what there are countries around the world. Korea is a good example. The women manage the household finances and they give their husbands an allowance, and they generally just drink and gamble that allowance. Proven they can't really be trusted. With money. And I think for us, what we've created in terms of the risk, our sort of risk engine is the ability for the engine to look at an individual or a business and not rely on the traditional credit score. If you've got a high traditional credit score, great. You're already sorted. If you don't, we can actually the engine fundamentally can look at that individual, that business, and be able to make a decision on whether they are likely to repay or not.
So would you be looking at like historical cash flow?
So it looks at everything. We have, I mean, without getting too data geeky on it, it's a set of mini models that take in over 500 data features to make the predictions on there, and has obviously been back tested and trained on the billions of transactions of people that have used and signed up to the platform over the last 4+5 years. So initially it was rules based, and then 2 years ago we had enough data to start to transition it to an AI or machine learning approach. So what it tends to do is it looks at everything from expense spending patterns, where you're spending, how you're spending, general cash flow, debt to income, all those sorts of things are sort of that some of it, and then some of the things you say are traditional things. But actually, what we've gotten to is the point that you can actually look at two things, whether they be people or businesses, and they visually to us look the same. Oh, similar income, similar expenditure, similar debt, same credit score, but the engine itself with a massive amount of data features is actually still able to separate those two out using a multitude of things. I mean, I think one of the more amusing ones that has an impact is what their email domain is. So Gmail is less trustworthy than Hotmail. And when you really think about it,
no way, I do. That has got to be fake somehow.
Like that. And it's only because when you really think about it, is that, or like Yahoo. Let's say you've got a Yahoo email.
Are those like ghost domain accounts? Like, isn't that what you use for your spam?
You'd think that, but it turns out that if you're signing up for like an account on an app using Yahoo, you've had that email for a long time. And whereas if you're John Smith 2765871 at Gmail, you're a little less trustworthy than John.Smith at hotmail.com.
I don't even have my Hotmail anymore. I locked myself out in university and I couldn't get back in. And then the one before that, well, I had to get rid of that one because it was a juvenile.
And that's where some people obviously, that's where you see that people need to make that transition from teenage or university emails to like, you're going to need a more adult one if you're going to be doing adult activities.
Definitely. So my other question was, so you mentioned that you kind of target the gig economy for this service. Or that's your main...
It's the main, although I'd say what we found is that you need to be clear on the definition of gig economy. So you say gig, and a lot of people are like, so it's Uber, Deliveroo, DoorDash, that sort of stuff. And it's no. They're part of it, but what we've found is that it's everybody from those workers, it's web designers, it's freelancers, it's construction workers, it's retail, it's hospitality.
Sole proprietors, pretty much.
Yeah. But all the way up to, the British Army is quite big for us as well. So, you get some interesting ones. There's public servants that still can find benefit on the platform as well.
So is there a threshold? Like, does someone start out as, one of these groups and they get too big and then you're kind of like, okay, it's time for you to go to a bank? Or are you able to continue to service them?
Most of them most of the time we're able to service them. There's occasions when what we've found is that they'll keep aspects of the product. So here's a good example. So that, like, say I've got income instability, and and the product's been working really well for me. But I go and I now go and get a salary job. So I have a flat income. The income smoothing product then is no longer appropriate for me. So I still want to build my traditional credit score. So I'm going to switch to the credit building product, or I'm going to switch to the one of our other sort of capital unlocking type products. So it's more about making sure that they've got the right thing for them, and as part of us, one we think it's a moral duty, but the regulators are starting to catch up as well, that the products that the financial products people have should be appropriate for them. It's not just a case of, oh, sign up here and pay me money, and you've never used it. Brilliant. Thanks for all that. Thanks for paying for something that you've never used. It's not like they can choose to use it how much they want. If you think about Netflix, you can choose to watch none of it or a lot of it. Steady pay income smoothly, you can choose to use it a lot or not. But it's still that ability to have that choice. We've got users that we offer money to that don't take it. And it's because for them it's a safety net that if they need it they'll take it, but in reality they're not going to take it every time they get offered. They earned a little bit less. Do you want some money? No, I'm okay at the moment.
So one of the things that I've been very much just generally interested in is digital nomads, and a lot of them tend to fit the demographic of what you're speaking of.
Yeah.
And so they don't need, like, they could just be a UK citizen, sign up for you and live wherever they want and still have that service work? Or do they have to be location bound?
No, they don't have to be location bound. So from a regulation perspective, they do need to technically be a UK resident, but it's more a case of that they're, depending on how they're playing the taxation game, generally need to be tax resident somewhere. So a lot of the time, the digital nomads will be working around the world, but they'll still have a postal address in the UK, etc., which they can happily use our service, and they'll be working for multiple customers. But they'll still be using and getting paid into their UK bank accounts. So
that leads me to another question. So in trying to create, I suppose, a flat service offering where jurisdiction and regulation doesn't matter for those types of nomads, kind of, when I say regulation doesn't matter, I mean that loosely.
Yeah.
Like, for example, you have Estonia had sort of the global digital ID and account and things like that.
Yeah.
Is it in your roadmap to maybe design something like that so that anybody who's just digitally moving around doesn't have to worry about, I have to be here, I need to do this? They can just go to, say, we'll call it Switzerland or something. To sign up your service.
No, definitely, and I think it's we've got quite a few things on the roadmap that I think the ability to create that sort of globally free view, and behind the scenes we handle the complexity in the sense of so it's not so just like we do for a number of our partners or people we provide our services to in a white label sense. We handle the regulation and the compliance. So similarly, in that sort of digital nomad scenario, once we get there, it will be a case of actually you're based in Portugal. Cool. We'll handle the complexity for you. Don't worry about it.
Okay. Cool. So since you mentioned Portugal, I guess we should talk about Web Summit, which is where we met.
Indeed.
So was that your first time there, or you a regular?
No, that was my first time there, and I'd say I was slightly spoiled, but also set the bar for Web Summit. So I was speaking there this time around. I'm speaking again this year, and I'm going to Collision as well. So sort of doing
what will you be speaking on at Web Summit?
So last year I spoke on Fintech, or one time I was speaking on Fintech and the cost of living crisis and how we can help solve it. And then I also spoke on an unbanked panel about how to effectively try and help solve the unbanked problem in emerging economies. This year, topics yet to be announced, but I would say I'll probably focus a little bit more on embedded finance and how embedded finance can help small business improve effectively margins, performance, basically lift themselves out of a recession. So the marketing guys need to come up with a pithy way of saying that, because and the Web Summit team, they're quite good at coming up with the one-liners for the talk. But it'll be something around back to part of my thesis is that small business are the drive, are the engine of most economies. How do we help enable those?
I will also be at Collision,
nice.
As it is in my backyard. So are you going to be talking at that one, or you're just attending?
I generally I try to only turn up to events that I get to hear the sound of my own voice at. So yes, I will also be talking in Collision.
Okay, will be the same topic, embedded finance.
Most likely. I mean, we'll work with the team on what's going on there. So I mean, we'll see. I mean, I could focus a little bit more on the consumer angle and cost of living as well. So it'll be one flavor of those effectively. Because I think the other thing for me is that I see, and I work with a lot of other founders in fintech, and fintech is ultimately an ecosystem. So a lot of time people think of things as very competitive. In reality, you can actually sort of help a lot of fintechs rise at the same time by improving things as an ecosystem. So it's not just a case of going, oh yes, I must capture as much of the market or as many customers as I can. Actually, you can help empower other businesses, which in turn empower others, etc. So it can actually be quite a powerful cumulative sort of play.
So, like in terms of traditional banks, do you view them as complementary, as competitors? Like, is the desire to disrupt something that they're offering, or work with them until one of them buys you?
So good question. So I'd say we don't tend to see them as a competition, mainly because, and would be the harsh version of it, they actually don't want any of our customers or any of the people we work with because they don't see them as profitable. So a traditional bank, for a business perspective, would any business coming in ideally, so unfortunately regulatory they have to accept these customers, right? But if they had the choice, they'd go, oh, have you got 2 years of trading history as a business? Do you want at least 10,000 in credit? And are you prepared to personally guarantee some stuff? If yes, great. Come on in. We're going to make loads of money off of you. You're a brilliant customer for us. Similarly, as for an individual, they have similar boundaries in terms of, are you likely to eventually get a mortgage? Do you earn above the sort of the average wage? Great. Come in. We're going to make loads of money off of you. We love you. Loads of other things. I mean, you know finance as well as I do. A lot of banks, like their basic transaction accounts, lose money. They don't make any money off those things. A lot of the savings accounts don't really make a lot of money they're not really profit centers for the banks. So they'd actually push off a lot of customers if they could. And what a lot of the banks have found is that they were able to push off a lot of customers to the fintechs because they were easier to engage with and deal with, but they were actually relatively low margin on what the traditional banks would have considered unprofitable customers. And that's not to say that as a fintech you can't turn those into profitable customers. So going to the small business scenario, I see, and with a lot of the ones that we work with, a lot of these small businesses need smaller amounts of money, 1,000, 3,000, 5,000, 8,000. So they don't need more than 10,000. So if you're able to provide those small amounts of money in a cost-effective way, you actually have a competitive advantage when compared to those traditional banks. Similarly, we talked about credit score earlier. Those banks are not going to touch a lot of those people that don't have a credit score they like. Whereas for us, we're able to, one, help those people improve their credit score, but also give them better access to stuff sooner. Now, over time, we've spoken to plenty of the big banks around eventual partnerships and types of things, but I think they struggle generally to partner with fintechs. At some point, a lot of they will tend to buy. They do tend to buy them, but they tend to a lot of time, unless you're very service providery, they tend to really struggle in sort of a partnering sense. I remember talking to one a long time ago about FX. Like, why have you guys done nothing about the rise of what was TransferWise then and is now Wise? Like, well, actually, our FX business makes a massive amount of money. We don't want to change it, and we won't change it, and we won't change it until we have to. Which is the traditional banking approach. I get it in the sense of that if you were running the business, you're trying to preserve the cash cow, the revenue, for as long as you possibly can.
I recall some banker, I can't remember which one, and he was a bit more senior, and they were just like, do you ever worry about being disrupted by fintech? And he's like, no, we can just buy them. He's like, we don't have to do anything. He's just like, when it gets to a level where it looks like it might win, we'll just buy it.
Yeah. And the thing is, they're not wrong. And I'd say that the sort of what we're sort of seeing now with a reset of valuations, with a level of sort of actually businesses, need to be a bit more sensible in terms of what the valuation of a startup is, and they need to have some path to profitability or decent unit economics. And if anything, that's actually positive for big banks and big finance firms, because now the ones that survive are going to be better priced with better unit economics, and if they get to a decent enough scale, sometimes you go, they're buying them a bit late, but in reality, you're still buying it. So I mean, it's not fintech, but you look at Adobe's acquisition of Figma. That was they overpaid. Could that maybe they should have bought it a while ago, but at the same time, that was an app that could have killed them. So goodbye in reality. Similarly, Salesforce have a very strong acquisition strategy because the Salesforce core product itself isn't that good. Surprise everybody. But they continually buy lots of new, quite good products, force it into the stack, thereby forcing people to continue to use sort of the Salesforce ecosystem. So it's actually quite a clever play. And it's coming back to the banks. Over time, we will see more of them start to acquire things. It's interesting to see what they acquire when. So HSBC invested in Monese, and then eventually they've moved towards an acquisition. So for them, we're moving towards we like Monese for the immigrant infrastructure. In reality, I think what they bought them for is a cheaper version of TransferWise, because Monese is quite good at international transfer, and probably got it for a reasonable price, undisclosed, who knows. But you're starting to see more of those acquisitions sort of come up. NatWest in the UK bought Verdano, which is a banking as a service platform, and they have embedded finance on their roadmap of activities. How that will end up over time, hard to say. But this is the thing, they have the bandwidth, even though they're a bit slow, to spend quite massive amounts of money if they, as and when they want to.
So I have to ask this one more question on sort of the fintech space, because you can't have a fintech conversation without bringing up crypto. So are you doing anything with crypto? Are you planning to do anything with crypto? Yeah.
So crypto has been an interesting one. So I mean, I think in fintech and as a technologist, it's something I've followed for a long time and kept an eye on. And it's something we've continued to sort of think: is there a way of us being able to? Is there a role for us, or some way we can we want to work with crypto? And if I'm being honest, for us, the easy answer is, if we're looking about digital nomads, could we pay out? At the moment we pay out in fiat. So here we are paying out in GBP. Could we pay out in euros or USD? Sure, pretty easy to do. Therefore, it's like, could we pay out in USDT? Some sort of stable coin. Yeah, why not? But it's a very simple use case where we're applying crypto in terms of an endpoint in the scenario of we can pay out.
But you wouldn't be doing you don't view Bitcoin as like the I guess the stable currency.
No, so I'd say crypto by its very nature is very volatile. Although I know at Web Summit where the Binance founder said that this quote for the day was that Bitcoin is not volatile. The world is volatile. So I guess it depends on your perspective. Crypto is it's super early. We'll see things settle down over time.
So you'd be looking more at a centralized digital currency.
Yeah. So because we're still centralized and relatively stable. I mean, I know quite a few people in crypto, work with some of the crypto firms. and they're the ones telling me this. There is another FTX out there, so wait and see.
Oh yeah, there always is.
So it's a case of there is, and for me, and unpopular opinion, a lot of the crypto stuff for a very long time is a solution looking for a problem, and this is where a lot of time you're struggling to find a use case where it's actually helpful. And I'd say the fintech's bad enough. You've got this, some of these banks and startups, built from layers of providers. Crypto is even worse. Layers of projects that are sort of open sourced, or and you've built your business on these layers of projects that actually have a very high running cost. But you're super dependent on them, thereby creating a lot of issues. So we're going to see a lot more regulation. We're already seeing it from the SEC, and in a way that's a good thing because it actually will bring more discipline to it. The problem, or what it creates by bringing in more of that regulation, you already see it anyway. Working in crypto is relatively high cost. So a lot of the wallets, even the bigger wallets, 80% of the customers don't make them any money. So they're also actually struggling to find a way of creating something that sort of makes a lot of money. Now, no surprises when Bitcoin's on a run. There's more transactions, so the exchange or the wallets make more money because usually they charge on transactions. If things are down, they're not making as much money. So I think it's fundamentally it's an interesting space, but it's one of those ones where a lot of aspects of it are solutions looking for problems and getting better, but a lot of stuff is still done off chain because it's faster and more efficient to do it off chain because I don't want to incur the gas fees or whatever for whatever reason. But of course, off chain is where fraud or problems actually occur. So it's like, well, you're going to do it on chain, you're going to do it off chain. So it's an interesting mix between which one's actually going to win, and then what's your real use case for doing it, because you sort of go to the big promise of crypto as a digital independent fiat currency not tied to a global bank, all that sort of stuff. That's all cool, but the problem is when you see something that's new, when you see a new tulip and everybody runs after those tulips, and the price of the tulip goes up from $1 to $10,000. That means that and we've seen it with a lot of the coins. A lot of the coins themselves, they're not behaving like a currency. So if they're not behaving like a currency, you can't use them like one.
Yeah, I still think it's very early for crypto in general.
Yeah, absolutely.
When I'm thinking about it, I don't view all of them the same way I do Bitcoin. Bitcoin seems to be a bit different.
Yep.
My problem with Bitcoin is that it was really born out of 2008 and the view of the Bretton Woods system as the problem.
Yeah. But
it doesn't address what the problems were of gold. And so the problem is that, yes, it's created this very, you could say decentralized, more natural fiat system, but the number they chose is arbitrary for how many coins you can make, despite being able to do fractional trades. But it doesn't solve the problem that whoever has the gold is the winner, which is why they changed it in the first place. It also means that you limit how much you can grow an economy if there's only so much gold and everything's about gold.
Yeah.
And I'm dumbing it down here, but that is really what the big problem was with it. But by switching to the Bretton Woods system, we ended up with, I think that's what it's called. We ended up solving that problem, but we created a whole bunch of new ones, which is why we have to print money and do all these other things.
Yeah.
But a lot of the proponents of these, of this, they're only looking at specific components of the issues. So I would say that's probably the biggest issue I have, And I just think it's just going to be another asset in the mix. It's
ultimately yes. I mean, I guess the thing is, and we've looked at a few things over time. DeFi amongst them. So and don't get me wrong. I think it's important for us to understand where we sit in traditional finance versus decentralized, and how and where and when, and we may or could or think about working within a crypto world. But at best, it'll eventually be another asset class or asset classes, depending on which way you want to cut it. That can be utilized and how it works. I think the danger for us as humans is, and what I'm sort of observing is, we tend to, and we saw this in a lot of early startup innovation as well, which is digitization. So let's take the traditional, the manual process and digitize it. And so we're seeing this in sort of TradFi versus into DeFi, or even just a normal finance system, then moving into crypto, whether you want to be you can still be crypto and still be centralized. And what you're seeing is taking a traditional concept and just copying it into crypto. Fundamentally, so here we are. Here is derivatives. Cool. Let's do derivatives in crypto. With no real thought about how to make it better or different or any of those sorts of things.
People don't even know how real derivatives work. Even the people selling them don't know how they work.
Yeah, but it's a good. I use this example because a good bad example is it's high risk. 80% of them expire worthless. Most people, they're super complicated, loads of maths. Most people don't have a clue. They've caused lots of problems over time. Original intent though was a good idea. Let's buy. Let's allow the farmers to get wheat at a set price. But it sort of morphed out from there. But you're seeing the same, and sort of I then take those sort of traditional finance concepts and just copy it into crypto. And it's not saying something that I haven't thought about it, but it's sort of everyone understands it this way. Therefore, it's better that I just copy it, as opposed to trying to take them on that massive learning curve or go through the traditional, hype, etc. Because I don't have the time as in my business to wait. And this will be in some industries, being first is not a good idea, because you've been first, but actually, timing wasn't right. So wait 5 years, and if you launched 5 years later, you would have been significantly more successful.
Yeah, I mean, I think at the end of the day, we can all agree that the current system we're learning is not the best for everyone. And the new system is not necessarily the solution yet. And there's work to be done to figure it out. And that's my non-answer.
But the thing is, I think it's a fine answer, because even if you say things are going faster, I would have said that crypto in 2021 was behaving like the stock market of the 1920s. So there's lots of those sort of historical parallels you can draw to things. And was the stock market of the 1920s a bit more Wild West? Penny stocks, dodgy things happening. Yeah, it was.
But you could say that about 2020. Everyone who was a day trader in 2020 was a genius.
What?
They all know the markets, the
phrase I like it is, not until the tide goes out that you see who's swimming naked. And unfortunately, if you start trading at a time when everything's going up, you just look. It's human psychology. You can't help but think, I am the next messiah. I'm better than Warren Buffett. Look how much money I've made doing this day trading stuff. But in reality, you almost couldn't not make money. Whereas you look at the some of the funny ones for like 2022. I think it was like the Financial Times or one of those. 20 financial journalists, super experts, picked their 20 top stocks at the start of 2022, and then they evaluated at the end of 2022. That only one of them actually didn't lose over 40%.
Oh, yeah. Everyone's an oracle. So I'm going to move on to the wrap-up questions. So are you, I don't know if you're a big reader, but are you reading anything interesting right now? And if not, are you listening to anything interesting?
So I just finished Why We Sleep, which is quite an interesting. You can consume it in multiple formats. The usual story.
Just heard of that actually yesterday. It's
did
such
you?
a coincidence.
Oh
yeah.
wow! Yeah.
Yeah.
There you go. So I'd say recommend Why We Sleep, consumed in whatever format you like. So I read it and watched it on masterclass. So there's multiple ways of getting into audio as well. Big takeaways for me on Why We Sleep were just really emphasize the importance of quality sleep in order for you to actually be able to perform. And I don't even mean perform at a high level. I mean if you sleep is when our bodies are regenerating. So being awake is while you're dying, and sleeping is when you're regenerating yourself.
Yeah, I'm a little bit conflicted about reading it because sometimes ignorance is bliss. And, knowing that eating a McDonald's cheeseburger is bad for me, and I'll still eat it, and I'll just live with the guilt. Yeah. So I feel like if I read the sleep, I'll hear all the things I'm not doing that I can't do.
Yeah, there's a level of, I don't know, people have read it that have that end up with anxiety, with more anxiety after reading it. It's like, I'm going to get cancer and I'm going to die.
That's always the issue. That's the thing when you learn all this health stuff and then you're just like, well, realistically, my lifestyle.
Yeah.
Now when I do it, I can feel bad about it, I suppose.
But some of us, it's more about, and he's not too bad in terms of his message, the level of sort of moderation. And if you have everyone has a bad sleep sometimes because, life. Don't beat yourself up about it, but try and get some. It's a lot of its basic routines, and one of the big ones that I quite liked was in the evening. If you particularly want screen time later in the evening, buy some blue light blocking glasses. So it's not like don't sit there doom scrolling TikTok if that's really what you want to do, but
That's probably my biggest problem because I try to manage my sleep as well, and I do the tea and I try to dim the lights, although that doesn't always work so well. But the thing is, I like to watch whatever it is I want to watch. I like to watch it before bed.
So that's a lot. So that's the thing a lot of people do, and I think for people that I've spoken to that do like that, and sometimes struggle to get to sleep, they've actually found the blue light blocking glasses to be like a massive help. Like they'll actually feel, even though they're watching something, they'll naturally feel tired and will go to sleep.
Oh, nice. Well, I'll have to try that. So I know you're a busy entrepreneur. Maybe you don't get time to watch anything that's going on in the pop culture shows, but I usually always bring one up. And the one I'm kind of obsessed with at the moment is The Last of Us. I don't know if you've heard of it.
I have vaguely heard of it, but I have not watched it.
So, as if we don't have enough apocalyptic problems, that is the type of show that this one is. It's an HBO one. That's the only reason I bring it up, because some people might be watching it. But it's a cool concept. And it's really the world ends because of fungus.
Because of fungus. Okay.
Yeah, because there's I don't know if you've heard of the zombie fungus. It's a real thing.
I have not something else to be anxious. Something else to fuel anxiety, I guess.
Oh yeah, absolutely. Because this would never have happened if we would have all just gone green earlier. But
absolutely.
But it's loosely based on there's a fungus that goes in an ant and then forces the ant to climb the highest tree so a bird will eat it because it wants to get into a bird. And so in this case, it turns a zombie kind of landscape, but through fungus.
Interesting.
Which I think is kind of neat because, it's actual real zombie stuff in nature rather than something we created in a lab.
Yeah. I guess it's interesting to see those sort of some of these post-apocalyptic things seem to be like, zombie fungus or, bees die out and therefore there's no more food, so we're done.
There's that one. I mean, are you watching anything interesting?
What was the last thing that I watched in terms of a series? The last series I watched was Rings of Power. So the
Rings of Power. Is that the Lord of the
Rings? The Lord of the Rings prequel, and really it's more just to watch because a lot of it's filmed in New Zealand. I just used to watch the scenery and be like, oh yeah, I've been there.
Okay, so you're talking about the Amazon series.
Yeah. So they
okay. I didn't know that was filmed in New Zealand.
Yeah, cool. So and they supposedly they spend a ton of money on it, but it's one of those shows. It's not this bad production value, but you are wondering where they spend all the money. And interestingly, like it's good world building, but I can see why a lot of people didn't like it.
The thing is, I don't know enough about the Lord of the Rings lore to not like it. I was just like, okay, so this is their Witcher. This is really kind of what I was looking at because it comes out at around the same time, and some of it was a bit okay. A lot of hidden societal meaning stuff, I suppose. In it.
Exactly. I did find they did find it funny that obviously there were sort of various flavors of United Kingdom accent, but it was sort of funny to sort of the various the humans sounded like sort of commoners, and the dwarves sounded Scottish, and the hobbits sounded Irish. And the elves had an upper class English accent. It was sort of funny.
They definitely have to have the class system, and especially since America is the target group. Like you couldn't have the top guys like having like I don't know an Irish accent. It just wouldn't work for nothing against the Irish, by the way. But I'm just saying like for some reason, like someone was telling me they did a study in the U.S. and they use a very specific accent from the British for their news reportings because that accent is perceived as that person is smart. Where there's a lot of the like general, there's lots, but there's another generic British accent that creates animosity and hatred because it sounds condescending. And so like they've actually done studies with different British accents on test groups in the US to see how it goes. Because you'll notice like newscasters have a very particular British accent, especially CNN. It sounds like this guy's definitely smart and has authority. And like even in some of their like sitcoms, or I forget which one it was. I think it's like How I Met Your Mother and Friends. There's like professors. And when they get their first professor job, they pretend to have a British accent so they sound smarter. Like stuff like that. So there is this sort of like belief on that, at least over here. In the UK, I'm sure you guys know what all the accents are. So so you have a different opinion of it.
Slightly different opinion.
Well, it's like I spend some time in Wales, and so sometimes I don't even know what they're saying.
Well, that's people that whether it's Welsh or Scottish, they really struggle to sort of know what anyone's saying.
Oh, I met a guy from Scotland, and I have no idea where, earlier this year. And a lot of it was just me going, yeah, that makes sense. Sure. I just had no idea what he was saying. No idea.
Nod and smile approach. Yeah. I have no idea what you're saying.
It was just so thick. I couldn't follow him at a lot of points. And so I don't know if at some point you're thinking, did he just nod to that? Doesn't he make any...
Why does he agree with that?
Anyways, John, thank you very much for joining. Is there anything you want to shout out? This would be the time to do it.
So shout out obviously for anyone who either is interested in SteadyPay. Feel free to check out our website, so S2EP17.co, not .com. So we do not have the .com, so .co. For us, obviously, on the investor side, not raising any money at the moment, but always looking for new relationships that we're fully believe in, lines, not dots. So we like keeping the communication lines open with investors, friends, and partners.
And are there any social channels that you would like people to follow as well? I know you're on the talking circuit here. So.
Yes, I'd say, obviously LinkedIn is quite good. I do try and publish reasonable amount of content myself on LinkedIn, so you can easily find me on LinkedIn or follow SteadyPay. And obviously we're on Facebook, TikTok, and Instagram, and probably others that I've forgotten because, there's more social channels than that.
Perfect. Thanks.
Cool. Thank you.
You can find information about the Candid Capital podcast on the website, LinkedIn, and Twitter. Episodes can be found on Spotify and other podcast platforms. A quick reminder that this is infotainment and is not intended to be professional advice, malicious, or hateful. The views, information, or opinions expressed during the podcast are solely those of the individuals involved and do not represent those of employers, partners, and their subsequent connected private and public associations or organizations.
We candid, I hope you understand it. Your business growth, we planned it, yeah. This ain't for show, we stamped it, yeah. No FOMO, everyone come join, no solo. This all factual, from me to you, this Candid Capital.